नमस्कार व्यूअर्स। मैं राकेश जैन, मेंबर इन्वेस्टर एजुकेशन एंड प्रोटेक्शन फंड अथॉरिटी एंड चार्टर्ड अकाउंटेंट बाय प्रोफेशन। मैं आज आपको फाइनेंशियल एजुकेशन एंड इन्वेस्टर अवेयरनेस की प्रेजेंटेशन दूंगा। ये प्रेजेंटेशन हम अप्रॉक्सीमेटली 60 मिनट्स के लिए चलाएंगे और इन बिटवीन हम एक थोड़ा सा शॉर्ट ब्रेक लेंगे। इस प्रेजेंटेशन में हम सब बेसिक कॉन्सेप्ट्स कवर करेंगे। बेसिकली अगर हम देखें कि इन्वेस्टर कौन है, एक ह्यूमन बिहेवियर है, ह्यूमन एस्पेक्ट है, तो हम की कॉन्सेप्ट्स ऑफ ह्यूमन बिहेवियर विच आर रेलिवेंट फॉर फाइनेंशियल एजुकेशन एंड इन्वेस्टर अवेयरनेस इस एस्पेक्ट को कवर करेंगे। इस प्रोसेस में हम डिफरेंट एसेट क्लासेस को कवर करेंगे। हम प्रोज एंड कॉन्स ऑफ डिफरेंट एसेट क्लासेस कवर करेंगे एंड देन something very close to my heart is investment in equity markets. We'll cover that. That is investment in equity shares. And then we will cover finally the safeguards which should be followed by investors while investing. So I will start the presentation with some key concept of human behavior for financial education and investor awareness. जैसा कि मैंने कहा कि इन्वेस्टमेंट जो है बेसिकली एक इन्वेस्टर करता है जो एक ह्यूमन बीइंग होता है। अगर वो कॉर्पोरेट के लिए भी इन्वेस्ट करता है तो फाइनली सम डायरेक्टर्स या ह्यूमन बीइंग आर इन्वॉल्व्ड हु आर मेकिंग द इन्वेस्टमेंट्स एंड हेंस द ह्यूमन बिहेवियर एस्पेक्ट बिकम्स वेरी वेरी इंपॉर्टेंट। सबसे पहला एस्पेक्ट है फियर एंड ग्रीड। नाउ व्हेन वी टॉक ऑफ फियर एंड ग्रीड, दिस इज अ वेरी simple thing that every human being is covered either by fear or greed when he makes investment. When we say fear and greed, what does it mean? Greed means when he makes good money, he gets greedy and he wants to make more money. When he loses money, he becomes fearful of the markets or investments and then he wants to get out of the investment and want to go to the safe pasture. Now, at the end of the day, one has to realize that there are risks associated which we are covering in our part number C, that is risk reward relationship, कि risk की और reward की एक relationship होती है. In other words, more the risk, more the rewards. Now, risk means if more risks are there, there is a risk of even losing the capital. Hence, one has to understand that risk management कितनी हद तक करना है हमें और हमें return कितनी चाहिए. And that is where the fear and greed comes in place. For expecting good return, we make investment in risky investments, and the moment it starts giving losses, we become fearful and we start looking to book the losses. And at the end of the day, investor generally books the losses and gets out by losing part of the capital also. And hence, as a part of investor education and investor awareness program, it is very important to understand this human aspect of fear and greed. Like Warren Buffett had said, that you should be fearful when the whole world is greedy, and you should be greedy when the whole world is fearful. That means when you see that the market is at the worst, you can become greedy or you can consider investing. While if the market is very, very bullish or very, very high, and everybody is very greedy, that's the time for you to become fearful, because like a day, after every day there is a night, and after every night there is a day. The same way the market also operates. When it goes very high, it comes down, and then when it comes down, then it again goes up. So it always goes in a form where it goes up and goes down. Hence, it is very important to understand the concept of fear and greed. The seasoned investors knows how to control fear and greed, and in their investment philosophy, it is very clearly evident that they make investment in such different asset classes where the fear does not grip them and greed does not bring them to a level where they become too greedy to invest every money and rather start borrowing for investments, which is not recommended at all. The second aspect of human aspect is demonstration effect. Now, when we talk about demonstration effect, it's a concept even taught in economics that अगर मेरे पड़ोसी के पास एक अच्छा टीवी आया है तो मुझे भी टीवी चाहिए. अगर मेरे पड़ोसी ने कार ली है तो मैं भी कार लूँगा. That means you take your decision not on your own position, on your own on thoughts. You take positions considering the other persons. In fact, SEBI had come out with a very interesting advertisement, and I quote that advertisement in a lot of my lectures, where they talk about that one person is saying, "Oh, Vinod has made a lot of money in the market. Why are we not making money in the market?" And they start investing. Similarly, the other person also is told that Vinod is making a lot of money. The word spread very fast. And one lady who had been cleaning the utensils at home, her husband told him that Vinod has made a lot of money in the stock market, so we should also invest. And she innocently asked, "By the way, who's this Vinod?" And the person didn't know who's this Vinod. And they kept on going to the person from whom they heard, and finally they found that there is no Vinod. And it's just a demonstration effect which prompted people to keep on investing more and more in the market without understanding that money cannot be made like this. Big money cannot be made just by fluke or by chance or by investing in the market. Market has their own risks and they have to be understood. So from investor awareness point of view and financial education point of view, we must understand the relationship of fear and greed as well as demonstration effect and risk reward relationship. That is, more the risks, more could be the reward. Lesser the risks, lesser would be the reward. And hence, that is very important when we'll talk about further in my presentation. We'll be talking about how we should manage the risk of investment so that we do not lose. We may not make big money, but we may not lose money also. It is very important to protect the capital which one is investing. The other important thing in investing is that time in the market is more important than trying to time the market. And this is more relevant for equity investment. Like a lot of time we say, okay, right now the market is very high, so we should wait for market to fall and then we will invest. And in that process, when the market falls, then the fear grips in and then we say, no, it will fall more because the expectation becomes that market will fall further, and we start waiting for more to fall, and one fine morning it starts going up again, and then we don't invest because we have seen the smaller or the lower part of investment, lower part of the market. Hence it is very important, like Warren Buffett has said, time in the market is more important than timing the market. In fact, I remember one of the conference where Mr. Mark Mobis, a seasoned fund manager, had been asked a question, what is the best time to invest in the market? And he said, the best time to invest in the market is whenever you have the money. Because if you are investing for long run, finally, even if you have invested little bit at a higher level initially, in the long run, it will get compensated and you will make reasonably good return. And hence, one should think in investing that we should put more time in the market than trying to time the market, because nobody can time the market. If anybody can say that I buy at the lowest level and sell at the highest level, I think he is fooling himself or is not telling the facts. It never happens in the market, and this I am telling you with my 40 years of experience in the investment markets. The other aspect is risk management. Risk management is a very important aspect of financial education and investor awareness, because everything comes with risk. Like we have said, risk reward relationship, more the risk, more the reward, lesser the risk, lesser is the reward, and hence we must do a risk management. And how risk management is done? Risk management is done by identifying the various risks associated with different asset classes, and then at a later date allocate your total investable funds in such a way that you take a moderate risk. In other words, you make part of the investment in high risk assets, and while you make the investment in low risk assets also, so that even if at any point of time the market is tough and you are not able to make good money, at least you will not be losing substantial money and you will always have some cash or liquidity available. Particularly when market falls, you should have liquidity available so that you can invest more. Because some stocks, if you are liking it at a X price, and if it falls to X minus 50% say, then it should become more profitable, more advantageous, and more interesting for you to invest in that stock. provided you are convinced that the stock has the upside and the stock's fundamental has not deteriorated. Hence, these 5 aspects are very, very important aspects of human behavior which should be understood by every investor while making financial investments. Fear and greed, demonstration effect, risk reward relationship, and one should put more time in the market. That means investment should be more for long term and not for short term. And we must do a risk management through asset allocation. Now, let me explain you what is asset allocation and what are different asset classes. If we talk about, we have giving the slide where we are defining the various kinds of asset classes, the terms associated with those asset classes, the expected return of that asset class, and the risk involved, and some specific features which those investments have. Like the number one is tax-free bonds. Now, for development of infrastructure and all, the government announces certain bonds on which interest is tax-free, that they are called tax-free bonds. And presently, NHAI, HUDCO, IRFC, etc. have issued these bonds, and these are traded on National Stock Exchange. And hence, you can buy or sell in the first IPO also, and if suppose you have missed the IPO, you can buy it from the market. The only negative part of this is that the volumes in the market are not very high, and hence, if you want to buy of a huge value, you may not be able to buy in one day. It might take you 3 or 4 days. Similarly, when you want liquidity and you want to sell them, you may not be able to sell them in one day. It might take 3-4 days. Again, depends on the quantum. If you are talking about 5-10 lakhs, it's okay. You can do that. But if you are talking in crores, it may take little longer time. Hence, you must look at this product from that angle. It gives you around 5 to 6% tax-free returns, and that is considering their coupon rate is 8.1%, but they are available at a premium. And when you buy them now at a premium and redeem them at par, there is a loss of premium also which gets allocated or shifted to the 3-4 years left for these bonds, and hence the net return is around 5 to 6%. Then RBI issues RBI taxable bonds. RBI taxable bonds are of 7 years, but they are not traded in the market. That means if you invest, they give you around 7.15% return, and the risk is low because they are guaranteed by Reserve Bank of India, but return is also low. Then you can put your money in fixed deposits with banks. Now the fixed deposit rate generally ranges between 5.5% to 6%, 6.5% now. Only I recently noticed that Canara Bank has announced a scheme of 666 days, less than 2 crores for 7.5% also. With RBI increasing the rate of interest, repo rate and all, this rate of interest may go up, and seeing the scenario, this fixed deposits rate can go. The only risk is low, but the risk is of the bank where you are making the fixed deposit, because the insurance which RBI and the government provides is the deposit up to 5 lakhs only, and hence you should be very cautious when you put a fixed deposit of the bank, that the bank should have a good standing, and you should not only go for a return, you should also consider that the bank has a good standing and the bank won't fail. As I stated, different banks are offering different rate of interest, but one should keep in mind the standing of the bank, reputation of the bank, and size of the bank, because in case the bank fails, one can lose the amount deposited to the bank because the insurance is only up to 5 lakhs of rupees. Mutual funds. Mutual funds also provides low risk investments in the form of liquid mutual fund, where the mandate given to mutual fund is that they will invest in only liquid securities, which will be having a duration up to 90 days. These have low risk. When we say low risk, is very, very low risk, but the return on that is around 4 to 5%. With increase in rate of interest, and if the interest rates gets further increased, the return on liquid mutual fund may also go up. Gilt mutual fund. In this, the mutual funds basically invest into government securities, and this generally is giving a return of around 7% or so on a in last 10 to 15 years, it has given a 7% return. Present yield, which is available on government securities, around 7.4%. And if you take around 0.5% as the expenses of the mutual fund, you can expect a 6.9, around 7% to 7.5% return on gilt mutual funds if you invest it for long term. But in the short run, the gilt funds are subject to interest rate fluctuation, because since the underlying securities invested by mutual fund is government securities, and if the interest rate goes up, then the value of the bonds comes down, and if the interest rates comes down, the value of bond goes up. If the value of bonds goes down, then NAV available to the investor gets affected. But if a person keeps it for long term, say till the maturity of the bonds where the mutual fund has invested, say 7 years, 10 years or so, then generally he will get a return of 7.5% presently. But with expected increase of interest by RBI in the coming RBI monetary policy, we expect this yield may go up. And hence, gilt mutual fund could also be considered. The risk in this is very, very low, because finally the fund is investing into the government securities. That means all these securities are guaranteed by the government of India. However, as I said, it is subject to interest rate risk. Interest rate risk can affect your return on investments. Besides, they have other mutual debt funds where they invest into corporate loans, etc. Here, the risk is of credit worthiness of the persons to whom the mutual fund has given the loan, and hence it has a certain amount of risk which is there, and that is the reason the return in this can be 6 to 8%, or in the past it has been even 9% or 10%. Then the government of India has come out with specific schemes relating to senior citizens, where the interest rate offered by the bank is around 7.4%. However, the person who can get this interest has to have an age of more than 60%. Plus, there is a cap of investments of 15 lakhs rupees. That means you can at best invest up to 15 lakhs rupees in this scheme. It has a lock-in period also of 5 years, and the investor has the option to extend it for another 3 years. Then there is another Pradhan Mantri Vyay Vandana Yojana. This is implemented through LIC, in which you can invest, the senior citizen can invest up to 15 lakhs, and a monthly pension of 8,750 could be available, and the return on that is around 7%. The monthly pension is taxable. I'm only covering these schemes for retired people who want to invest their money in the safe investments. So these could be good investments where their money could be fairly secured. Public Provident Fund could be another investment opportunity for younger people, where they can put money in Public Provident Fund. I will be covering about the problems and hassles, pros and cons of each asset class separately in later slides. So Provident Fund, again, one can put in. There's a lock-in of 15 years. That means you can when you start putting. The other aspect of Public Provident Fund is that every year you have to put some money into this, and if you do not put the money, the scheme lapses. And another aspect is that amount invested in Public Provident Fund gets you a tax deduction under Section 80C of the Income Tax Act up to the limit of 1,50,000. Considering the other investments of LIC, insurance, Provident Fund, etc., this total limit of 1,50,000. And hence one has to look at the individual aspects of their own situation, and then only they can consider investing in Public Provident Fund. Then there are certain schemes of post offices which are available to investors, like Post Office Monthly Scheme, where the interest is around 6.6%. You have to put every month the money in post office. You have to visit post office, get the entry made, and this has a lock-in of 5 years. This is generally available to for small investors, and the total amount any investor can invest in all or different post offices is 4.5 lakhs per year. The limit is 4.5 lakhs per investor and not per post office. And That's, in other words, if a person is investing through 3 post offices, at best he can invest a total of 4.5 lakhs only under this scheme. Then post office has another scheme which is called National Savings Certificate Scheme, where the interest rate is around 6.8%. Since these are guaranteed by post offices, that is Government of India, the risk factor is very low. This also qualifies for deduction under Section 80C of the Income Tax Act 1961. Besides, government has introduced new scheme which is National Pension Scheme. NPS is basically made on the lines of international pension schemes, where a person, particularly self-employed person, can take this policy and keep on paying every year the money, and at the time of giving the money you have the option to choose where NPS or this authority, National Pension Authority, should invest your money, whether they invest it into low risk assets, medium risk assets, or high risk assets. Based on the risk assets, your return also gets determined, and finally the NPS authority invests the money in those asset classes, and for that purpose they either use mutual funds or use LIC for the purpose of investment as their fund managers. The benefit you have is that after the tenure of the pension scheme, you can get 60% of the money in lump sum, and for 40% they will give you an annuity, which will be given on an annual basis as a pension to you at a specified amount. The other asset class could be international funds. International funds are basically mutual funds who are mainly investing into US markets and other international markets. International funds are more important for people who have large asset class, because it basically covers your currency risk. In other words, you are investing your money in dollar terms. SEBI and RBI permits mutual funds to invest up to a certain amount into international funds. So what happens is that you invest in the mutual fund in rupee. That mutual fund in turn will invest either direct shares of international market, or will invest into international mutual funds which are denominated in dollar terms or in foreign currency. Thus, if at any point of time your currency devalues to a very large extent, you may suffer losses in India, but you will gain in this for international fund, because even if the performance of the fund has been at par or similar, but you will gain the advantage of currency, because in rupee terms the return will become higher. Hence, this fund, this investment asset class is meant more for people whose assets in hand is more than 10 crores, 20 crores or so. Because then by that process they are covering even the currency risk and sovereign risk. Gold could be another asset class where one can invest. In fact, besides gold being used as a jewelry, like in the past, gold has been used as a jewelry as well as an asset class for investment, and on the tough time of the family, the gold used to come very handy, or the ornaments used to come very handy, against which either the money could be borrowed or they could be sold and money could be realized. In a 30-year basis, gold has given a return of around 5 to 6%. In the past 3 years, gold has given good return, is around 9%, and gold is a natural hedge against stock market. The general feeling is that whenever market is high, gold is low, and whenever market is low, people go to the safer asset classes, and gold is one of the safer asset class. The risk associated with this is that gold is subject to market fluctuations, and since it is subject to market fluctuations, it has its own risk. So one has to understand. But if one is investing for long term, it could be a good asset class to invest. Maybe 5 to 10% of the total corpus of investable surplus could be invested into gold. For mutual funds, there are balanced funds. The balanced funds means that they put part of the money in equity shares and part of the money in debt. In other words, they try to give you a balanced portfolio. That means they take you little balanced risk. The return on this asset class in the past had been -5% to 12%. They have an exit load of 1 year in case you withdraw the money within 1 year. Balanced funds normally invest 65% of the money in equity shares and up to 35% in debt or liquid assets, where the risks are low. In equity, the risks are high, but the return is also expected to high. And that is the reason they are able to provide a little better return. Then we have unit-linked insurance plan as another asset class in which you make the investment, and in unit-linked insurance plan, again, the person who's running the scheme asks you whether you want your money in equity or in debt or in mixed, that is balanced. So that means you choose the risk profile. In other words, unit-linked insurance plan is nothing but investment in different asset classes plus buying the term insurance, so that in case a person has any fatality, then his or her dependents or nominees gets provided with the amount of capital risk of the insurance amount. And the insurance premium is very low. Finally, it comes from the investment return, which is made from the principal. Generally, ULIPs have been giving a return of around 8.5% or so. And the alternative to ULIP is that you yourself can create a term loan and can invest your money in mutual funds or in other places wherever you feel comfortable in terms of the risk profile you have. The last thing of asset class comes is equity investments. Equity investments can be made two ways. One is equity investment through mutual funds, and equity could be a direct investment where you yourself can buy direct shares in your account, for which you need to have a broker and you need to have a DP account, and the shares comes in your DP in electronic form. Our recommendations for startup investors are to go through mutual funds, because mutual funds invest in equity, but that is managed by professionals who have very good understanding of market, have very good financial education and understanding of investor behavior. And hence, initially, it is always advisable to start with mutual funds investment in equity, and one can go for direct investment in equity once he feels adequately informed and he has experience in investing. With this, I will take a small break and we'll come back again after the small break. Thank you very much.
क्रिटिकल है बट वी आर ट्राइंग।
ये सब हुआ कैसे?
एक फोन आया था राजेश के पास। उसने कहा कि उनकी 1 करोड़ की लॉटरी निकली है और उसके लिए उसने बैंक डिटेल्स मांगी। राजेश ने सारी डिटेल्स दे दी। 1 घंटे के अंदर ही उनके बैंक अकाउंट से सारा पैसा साफ हो गया और वो यहाँ आ गए। हार्ट अटैक आया है।
देखा आपने, आपकी जरा सी असावधानी क्या कर सकती है। डिजिटल फ्रॉड करने वालों से सावधान रहें। अपनी बैंक डिटेल्स, अपना डेबिट या क्रेडिट कार्ड नंबर, एक्सपायरी डेट, CVV, OTP, पिन कभी किसी को ना बताएं। सावधान रहें, समझदार बने।
IEPF अथॉरिटी द्वारा जनहित में जारी।
हाँ जी सुरेश जी, रिटायरमेंट के बाद जो प्रोविडेंट फंड आएगा उसका क्या करेंगे?
कुछ खास प्लान नहीं है, पड़ा रहेगा बैंक में, ब्याज आता रहेगा और क्या।
सुरेश जी, बैंक से कितना ब्याज आएगा? एक नई स्कीम बताता हूँ, उसमें पैसे लगा दो, साल भर में दुगने बल्कि चौगुना हो जाएगा। हाँ, बस कुछ नए मेंबर्स बनाने।
नहीं सुरेश जी, इन सब फालतू चक्करों में मत पड़िए कि नए मेंबर बनाना, रातों रात करोड़पति बनाना, ऐसे सपने दिखाने वाली स्कीम से बचकर रहें। आप लालच में आकर नहीं, समझदारी से निवेश करें। नए मेंबर बनाओ, वर्ल्ड टूर पे जाओ, कमीशन पाओ या उपहार घर ले जाओ। ऐसे सपने दिखाने वाली स्कीम से बचकर रहें। ऐसी स्कीम्स धोखा हो सकती हैं।
IEPF अथॉरिटी, कॉर्पोरेट कार्य मंत्रालय द्वारा जनहित में जारी। यार वो मेरे बचपन का दोस्त है, वो क्यों मुझसे झूठ कहने लगा? वो कह रहा था इस स्कीम में पैसा लगाने पर 6 महीने में 10 के 20,000 हो जाएंगे।
और तूने मान लिया?
ऐसा ऑफर कौन छोड़ता है? 10,000 के 20,000।
एक काम कर, ये ले 100 रुपये पकड़ना और जाके 10 किलो लड्डू लेके आ।
अबे पागल है क्या? 100 रुपए में 10 किलो लड्डू आते हैं? अबे इसके तो 1 किलो लड्डू भी नहीं आएंगे।
जब इतना जानता है तो ये नहीं जानता कि 6 महीने में 10,000 के 20,000 नहीं होते। समझदारी बढ़ा, लालच नहीं।
लालच में न आए, समझदारी बढ़ाएं। IEPF अथॉरिटी द्वारा जनहित में जारी।
कैनवास में रंग भरकर उसे जीवित बना देना एक कला कहलाती है। इसी तरह अपनी जमा पूंजी बढ़ाकर जिंदगी बना लेना भी एक कला ही है। मैंने भी ये स्टूडियो ऐसे ही बनाया है, पाई पाई जमा करके। मुझे भी लोग फ़ोन करते हैं, मेल करते हैं, मुझे कन्विंस करते हैं कि उनकी इन्वेस्टमेंट स्कीम्स बहुत अच्छी है। उन लोगों के भी रेफरेंसेस देते हैं जिन्हें फ़ायदा हुआ है, पर मैं अपनी रिसर्च खुद करती हूँ। आपको भी यही करना चाहिए। सरकार के कुछ वेबसाइट्स हैं जिन पर जाकर आप अपने निवेश से संबंधित पूरी जानकारी ले सकते हैं, और ये वेबसाइट्स हैं मैं अपने पैसों को लेकर सावधान रहती हूँ, आप भी रहिए।
IEPF अथॉरिटी द्वारा जनहित में जारी।
Welcome back, viewers. In the first part of the presentation, we have covered some key concepts of human behavior for financial education and investor awareness, and also understood different asset classes along with their return and risks which are associated with such asset classes. Now we will talk about the pros and cons of different asset classes, and we will specifically talk about investment in equity markets and safeguards which should be taken by investors while investing into equity markets. Hence, I will start with pros and cons of different asset classes. Now, when we talk about various investment asset classes, we have covered debt, bonds, fixed deposits, public provident fund, national savings certificate, post office schemes, other debt mutual funds, including liquid funds. And we also know that the another asset class is a property as asset class, where it's a very long established asset class. In fact, in the olden days, when the markets were not that developed, the main asset class for investments were property and gold. Property could be residential property, could be commercial property, and besides the own use, it can be used for renting and for appreciation. The pros, the advantages of property as an asset class is that it provides rental income and also provides appreciation of the asset. It is less volatile compared to investment in shares or in investment in financial assets. Capital growth can be very high in case the property is at a good place, and depending on certain uses of the place and the population of the place, the value of the property can go very high. However, it has its own disadvantages also. The disadvantages are, number one, it is less liquid. Like if you have to sell a property, it is not that simple that you can straight away go get the money next day. It may take even months or sometimes even years. And second, it's difficult to manage because you will have to do all the hassles of maintaining the property, and hence there are issues involved with the management of the property. Generally, the investment size in property is higher. Like any investment you will be making in property may start with maybe 10 lakhs plus. Transaction and maintenance cost of property as an asset class is a little higher. When we say transaction cost, when you buy, you pay stamp duty, you pay brokerages, and plus when you buy, you pay little higher premium. Similarly, when you sell, you pay brokerage, you pay stamp duty, and hence the transaction cost can become 10% or so either side. When you buy, you have to incur a cost of around 10%, and when you sell, you may have to incur a cost of around 10%. Hence, you can't do property transactions in a frequent manner. You may have to hold the property at least for 20-30 years to get a reasonable good return. And the rental income, which is generally associated with the property, is 2 to 3% of the value of the assets, which is very, very low. And hence, property as an asset class should be considered to the extent one uses, or one has to create a safety because it is a real asset. It is physical, visible, and it provides a status also to the investor in the eyes of the market and friends and relatives. Debt. As I said, debts could be of bonds, fixed deposits, PPF, NSE. Now, each one has their own advantages and disadvantages. Like bonds, gives you regular interest income and gives little higher interest than the fixed deposit rate, but your money is blocked for a longer period. The disadvantages. Plus, they are not that liquid like a bank deposit or normal money in the bank that you can go and withdraw the bank deposit by paying some compensation for but at least the money is available. In case of bonds, suppose you want to sell that and they are not sellable at that point of time, or they are not getting you the right price. At that point of time, you may get stuck, or you may have to sell at a desperate price. Besides, interest rate fluctuation can affect the value of the bonds, and hence this is the pros and cons of bonds. Similarly, fixed deposits, though it gives you regular interest income, but it is not very tax efficient, because whether you are getting the fixed deposit interest or not, tax has to be paid on the accrual of interest. PPF, NSE, post office, monthly schemes gives you regular interest income, but generally they have a lock-in period of 5 to 10 years, and it has management hassles like you have to go to the post office every month, get your passbook updated, and the working of the post offices at this stage is not that systematic, that sometimes it may take a little longer. You may have to stand in queue in case there is a rush and all that. So those are the hassles which are associated with post office investments, and plus post office investment is physical form. They are not in electronic form, and hence you get physical paper, you have to retain those papers, you have to keep those papers safe. Suppose you misplace those papers, it can become a big problem for getting duplicate and all that done. Other debt mutual funds could be liquid mutual funds, could be gilt mutual funds. They provide liquidity, like you can get the money maybe the next day or in T plus 2 days basis or T plus 3 days basis, depending on the asset class you have deployed. But it has interest rate risk, it has management cost of mutual fund, and hence at times there is a default risk, particularly in case the debt fund is a fund which is investing into corporate papers, and hence one has to be very cautious while investing into debt also. Your objective should be clear. You want risk-free investment, then try to invest only into liquid or ultra short-term funds only, where the money is invested into treasury bills or up to 90 days duration, or at best 66 months duration. The chances of a debt going bad in 90 days or 6 months are very, very remote. And secondly, even the mutual funds do their own due diligence before investing the money, that the investment is in a safe instrument. International fund. As I stated that it is a diversification from Indian market to global market, but this is subject to the disadvantage of currency risk. Suppose Indian currency becomes very strong, then in that point of time international funds can give you even negative returns. Suppose global markets do not perform, it can give you negative return. Hence, one has to understand that international funds are not for the purpose of earning money in present form. It is more for diversifying the different asset classes, and that too for rich people whose investable surpluses are much higher. Gold. As we said that it is a natural hedge against equity investment. Every investor should have 5 to 10% of their total investable surplus into gold. Gold provides the hedge. And when we are talking about gold, there is government's sovereign gold bond scheme in which you can buy those gold bonds which are represented by gold. Only thing is that government provides 2.5% extra interest every year on that, and you don't need to have the botheration of holding physical gold and then managing gold. The sovereign bonds comes in the electronic form, and they are available in depositories, and hence management is also very easy. So gold can be invested through ETF, they can be invested through physical gold form, or they could be investing through sovereign gold bond schemes of the government. Balance fund. Balance funds has the advantage of, they are, as I stated, they are hybrid funds, and they get the equity investment taxation, which is lower taxation than the normal taxation, in case 65% of the fund scheme is invested into equity, and only up to 35% is invested into debts or cash. The disadvantage of this is that you cannot get the 100% safety of debt as well as 100% upside of equity investment in this, because it's a hybrid. But since it's a hybrid, it mitigates the risk to some extent, to a large extent rather. And for small investors, it might be a good idea to start with balance funds and then go for equity funds through mutual funds, and maybe after 5 or 10 years of investing experience and learning, one should go for direct investment. ULIPs again is a insurance product plus investment product. So it actually is a combined product by the issuer, that it fulfills your investment needs as well as insurance need. The only thing is that it has generally a 3 to 5 years lock-in period, and it is not very transparent in giving you the NAVs, etc. Like NAV of a mutual fund is available to you on a daily basis. ULIP generally provides information on yearly basis. Senior citizen saving schemes are good for senior citizens, provided they are able to do the management of these schemes, because generally it may require going them to the bank and all and getting the different accounts operated. But retired people who have retirement fund to the extent of maybe 50 lakhs a crore should make use of these schemes to get better return. Equity mutual fund has a lot of advantages. It's the best investment option to achieve good long-term results. These are managed by professionals who have ample experience in the field of fund management. It is less volatile than compared to direct investment in shares, because here you buy a basket of shares, you do not buy individual shares. So suppose you bought a basket of 20 shares, because you are buying a mutual fund scheme which may have 20 or 30 or 40 shares. In other words, you are buying a basket of shares. So out of them, maybe 20 may perform very good, while 20 may perform bad. So when you do the average, you might find some return which is reasonable. The negative side of this is that you do not get the best return, because you buy a basket. When you buy a basket, the return gets averaged out. So you can't consider that you will multiply your money 2 times, 3 times in a year or 2 years or 5 years period. The disadvantage of this is that money is managed by somebody else. There are costs involved like expense ratios, exit loads, etc., which are associated with investments in. But considering the return which is expected, and I'll be covering that in my subsequent slides, that when you invest for long term, then investment in equity mutual fund could be one of the best options for the starters. And for people who have experience of 8 to 10 years, who understand the markets, and who can do their own research, for them direct investment can also be a very good option, provided they make investment into good shares and they hold the shares for 5 to 10 years period. Private equity could be another asset class where you are investing into new startups, and the return could be very high. But generally, the thing we have seen in private equity is that out of 10 investments made, 1 or 2 investment performs, but when they perform, they give you so much of money, which is which even covers the loss of 8 or 9 investments which you made, and plus gives you substantial return. The disadvantage of private investment is that they are not very transparent, and the period of holding investment is generally long, maybe 5 to 10 years. Shares direct could be another method, as I stated earlier. In this, you can make even small amount, like you can buy up to 1 share also of a company, and depending on the value of the shares, you can make the investment. The transaction cost in today's time has become very low for even direct shares. The liquidity is high because the stocks are traded at National Stock Exchange or Bombay Stock Exchange. The rewards could be very high, but so are the risks associated with that. That risk could also be very high. You can get 5 to 10 times return in 2 to 3 years, but you can lose the money also, maybe 50% of the money or 90% of the money in 2 to 3 years. And there are wide options of investments because like in BSE, there are more than 4,000 companies which are traded, and in NSE, there are around 2,000 companies which are traded. So there's a wide option available to you. You can look at the various sectors where you need to invest. Investing is a separate exercise, which I may be talking about some other time. I'm not covering the research part and how to invest at this stage. But we must understand the pros and cons of different asset classes. Having explained the pros and cons of different asset classes, now I'll cover one important aspect, that if we are talking about equity investments, then how should equity investments be looked at? My practical experience reflects that investment in equity can be made through mutual funds or direct shares. For the beginners, that is for up to 3 to 5 years investors, they should consider investing through mutual funds. And if after 5 years or 10 years, if they feel that they have got adequate knowledge and they can do adequate research, they can do good selection of companies, and they are not going by tips, etc., they can consider investing in direct in the market also. As I said earlier, as a concept, time in the market is more important than timing the market. And I would like to show this through the annexures 1, 2, 3, where we have stated that if you invest into, say, mutual funds, we have covered 5 major mutual funds like SBI Blue Chip Fund, Axis Mid Cap Fund, HDFC Flexi Fund, Kotak Flexi Cap Fund, and DSP Equity Opportunity Fund. And we noticed that when we look at the return individual years, there are variations. That means in some year you make good profit, some year you make even losses. But the moment you look investment for 5 years, 10 years and 15 years kind of a period, you find that generally you make reasonably good return, and return increases with the time. Hence, and they are generally positive. So individual years you may have even losses. The point I'm trying to make here is that if you are investing for long term in equity market, generally you will make good return, at least more than your fixed deposit or fixed yielding returns, and it is fairly secure because the companies these funds selects, like I'm giving you the example that these 5 funds has given on 5-year CAGR of 11%, 17%, 13%, 10.69% and 11.05%. On 10-year basis, the same return became 14.71%, 18.94%, 14.46%, 15.62% and 15.54%. That means longer the period, your returns improves. And hence, if you would like to invest in equity, which in my view and my suggestion, everybody should consider, one should consider through mutual fund, but for long term. Not that today we invested and we expect that tomorrow it will be double. It will never happen. If it may happen also, it may happen by fluke. It's not going to happen in perpetuity. Generally what happens, if it doubles very fast, then it falls also very fast. Hence, we should consider investing for long term, say 5 to 10 years period when we talk about investment in equity. Similar exercise we have done for various indices. As you would notice that in 1920, most of the indices has given negative returns. But when you look at 5-year, 10-year, 15-year CAGR, most of the indices has given positive returns, ranging from 13.4% to something like 14.81% when we talk Nifty FMCG. And 14.81% CAGR is a very good return for 15-year period because it's a compounded rate of annual growth. CAGR is basically compounded annual growth rate. So if you're getting 14% every year, That means for 15 years you are getting a substantially high figure. The power of compounding comes in play here. Similarly, we have talked about some specific stocks, and when we looked at some specific stocks also, we found that on individual year basis, these stocks may have given negative returns. But when it gets to a 5-year period or 10-year period or 15-year period, most of the stocks have given reasonably good return uh, and a positive return. And hence, if you are investing for long term and you are investing into good stocks which have moat, which have growth, which is having a good class of management, again, those are the criteria for selecting a good stock that I'll be covering up separately in some other lectures. But for the time being, if one can do that, initially one can learn it through mutual funds, and then later on, after 5 or 10 years of experience, one develops that skill to even identify the stocks which need to be invested, one can get into direct investment. But one thing is very clear: if you are thinking of investing in equity, one should invest for long term, and long term is the only alternative which can get you a good positive return. And you should be away from fear and greed. So if market falls, you should not become fearful. You should not jump on for selling. Maybe that's the time, keep some liquidity available or other asset class available, and that time even that other asset class can be converted partly into equity. So risk management is a very important aspect of investing, which everybody should learn and understand clearly. Now, this chart is establishing, you see, like when I was an economics student in my graduation, I was taught that stock market index is the reflection of the growth of the, is a barometer of the health of the economy of the country. In other words, stock market reflects the health of the economy. Health of the economy is basically reflected by GDP growth, with nominal GDP growth, which means GDP growth, real GDP growth plus inflation. Maybe reduced by dividends, which is distributed by the company, which may be 0.8% to 1%, considering the market price. The yield, dividend yield, is very low. We have seen, and we have seen this from established investors, that they have created a scenario that the index generally grows with the growth rate of GDP plus inflation minus dividend yield. Based on that, we have derived this chart, and we find that on an average, on a 10 to 15 years period, this fundamental principle comes in play, because on a daily basis, there are lot many other factors like geopolitical factors, like cash flow in the market, which can affect temporarily the market swings. But in the long run, it is the fundamental and it's the growth in the economy which determines. Now, considering this, we are anticipating that in the year 2025, the 31st March 25, our Nifty can go up to 24,433 or so, which is reflected by a mathematical calculation of present index multiplied by the GDP growth we are anticipating. And considering the data of RBI predictions and IMF prediction, we have taken a growth of around 7% from 24 to 26, and a growth inflation rate of 6% approximately, and a dividend yield of 0.8%. And considering that, we are talking about around a return of around 12%. Generally, when investment is made by mutual fund or direct investment by investor or portfolio managers, they basically provide some alpha. In other words, index growth plus 2 or 3% extra return is generally provided. And if we consider that, around 14 to 15% return can be expected annually in the market if one is investing for long term. In the past also, we have got a return of around 14% when we look at the index way back from 1980 when it started at 100, and the Sensex today is around 58,000. Similarly, Nifty 94, and today the annual CAGR is around 14% or so. Now I'll cover the last slide of my presentation, which basically reflects the safeguards which the investor should take while investing. The number one is, please do not get into demonstration effect. The example I gave of SEBI's advertisement that Vinod made the money, that means you should also invest and you will make the money, may not happen. And hence, we must understand, if somebody has made money, does not mean that we should follow blindly and invest. The timing of that person could be different. The time investment and the money availability could be different. If second, for the purpose of higher return than normal return expectation, can land into problem. Now, this is a very subjective thing. Like you have seen the advertisement of IPFA authority also, where they say that if you want, somebody assures you that I'll get you 100% return, 200% return. That means he is basically a con man. He will be scheming somewhere and you might finally lose your principal also. So while going through the return, you must understand the return which is expected, the return which can be got, and the reason why that return can come. If you are not clear how that return will be provided to you, please do not go only for higher return. Analyze very clearly that how high return is possible. If somebody can double the market, then why even all the banks do not put all their money into that investment scheme and double their money? Why do they land at 8%, 12% or so? So people with lot of money, why they don't put the money in those kind of schemes? One must question that. Borrowing or trust money should never be used for investment into risky investment, because in case you lose the principal, the borrowing stands, the interest meters remains. If you have used the trust money, because trust money has to be refunded, and hence that should not be used for risky investments. Complete financial discipline with lot of stress on risk management and periodic review is the need of hour for every investor. It should not happen that we have invested the money and after that we are not reviewing. We must review that we are getting reasonable return. We must review that our asset class where we have invested is perfect and is safe. Like suppose I have invested in a company A and for reasons company A has gone bad. If we are reviewing, we should be able to see very clearly that the company has gone bad, and hence one should see a continuous review should be there of your investments and financial discipline. Discipline is important in every part of life, so in financial understanding also and investments also. So with this, I will close my presentation and I wish you all the best. Happy investing. Thank you. Bye-bye.
We wear clothes on a daily basis. But have we ever wondered, where do our clothes come from? Who makes our clothing? And who are the people and the process responsible for the whole manufacturing of our clothing? If you want to know more about this, Indira Gandhi National Open University from the School of Continuing Education has launched a program which is Certificate in Apparel Merchandising. There are many benefits after doing this program. You can become a designer in various fields. It can be fashion designer, apparel designer, costume designer, or even a textile designer. One can also work as a fashion consultant. Research and development is another field which one can take up after doing this certificate course. Going into academics is another perk after doing this program. Getting into fashion houses or fashion studios as an intern is also a very good option post doing the certificate in apparel merchandising. The basic eligibility of the program is 10+2. The duration of the program is 6 months to 2 years. The program is also available for both the admission cycles, which is July and January. The exams are conducted twice a year, in June and December. So what are you waiting for? Join this program and get an enriching knowledge in the field of apparel merchandising. And to do so, you can log on to the official website of the university, www.ignou.ac.in.
हेलो व्यूअर एंड लर्नर्स, आप सभी का आज टेली कॉन्फ्रेंसिंग सेशन में ज्ञान दर्शन में सभी का स्वागत है. In today's session we are going to discuss and deliberate upon a program being offered by School of Vocational Education and Training, that is MA Entrepreneurship Program. So along with me, my colleague Mrs. Asha Yadav, also the course coordinator, program coordinator
Hello.
of this program. So both of us, we are going to discuss and deliberate upon the MER 006, that is the issues and management of MSMEs, which is very important part, very important segment of whenever we talk about any entrepreneurship. So MSME play very significant role. So as a part of program design and program structures as delivery, we organizes this teleconferencing IRC as a part of teaching learning process, and time to time we keep on doing, we discuss it over here, the questions raised by our learners, and as we feel also some questions is very pertinent for the learners point of view, we see that some questions which learners need further deliberations. So those topics, those issues we discuss in this our counseling session. So this counseling session generally we organize either on Gyan Darshans through teleconferencing. So there must be numbers must be displaying over there. So any learners of our program, that is a MAER program, if they have any doubt, they can put question to us. We'll be very happy to answer those questions. So in today's sessions, we are going to discuss the course 6, that is MER 006, issues related with the MSME. And in this session, we will try to cover 2 units of this course, that is unit 4 and 5. And unit 4 is related with the financial management of MSME, issues related with financial management, and whereas the second unit, that is the operational issues for setting of any MSME or industrial or production service, what are the problems, issues related with it. It's a very important topics with respect to the learners having interest on setting of enterprise or run the firms, what are the issues come, and both are very important. First is the financial part and the second is the operational part. So in this today's sessions, we are going to cover what are the business success or failures, what is the evaluating performance, principles of conservatism, asset management, growth strategy, the financial implications, managing liabilities, maintaining accounts, and as part of, as we are telling you that we are also going to cover in this session the 5th unit, that is related with the setting of units and plants, what is the product designs, development of prototypes, selections process, plant locations, layout, industrial engineering. So these topics we will cover in today's sessions, and as mentioned you, so first of all we will try to cover the 2 aspects as we have discussed, what are the success and what are the reasons for failures of any business. So I will ask maybe Asha will give light on to it.
Okay, thank you. As you know, today's topic is issues in MSMEs, issues related to financial management and issues related to operational management. And today we will discuss what is business success and business failure. हम सभी जानते हैं कि बिजनेस में हमें एक प्रॉफिट चाहिए होता है. जब हमारा प्रॉफिट होता है तो नेचुरली है हमारा बिजनेस सक्सेसफुल होता है. एंड लॉस मे बी एन इंडिकेटर ऑफ बिजनेस फेलियर. अगर हमें लॉस हो रहा है उस बिजनेस में तो वो एक इंडिकेटर है कि हमारा बिजनेस या एंटरप्रेन्योरशिप या हमने जो एंटरप्राइज या कंपनी जो अपना चला रहे हैं वो सक्सेसफुल नहीं है, वो लॉस में जा रही है. अब what are the reasons behind this business success and failure? how we can measure the things so that we can grow our business, and we can get profit, so that we can run the business or our company or something in a smooth manner. So business soundness of business or healthiness of business can be measured through break-even analysis, or the cash needs for the business, for the company or the enterprise. We estimated through the cash flow analysis. Cash flow analysis, it means the current assets like cash and the current liabilities. उसमें से अगर आप करंट एसेट्स में से करंट लाइबिलिटीज़ को माइनस कर देते हैं तो आप अपना कैश फ्लो स्टेटमेंट आपके सामने आ जाएगा, और आप समझ जाएंगे कि हमको कितना कैश रिक्वायर्ड है फॉर टू रन अवर कंपनी और एंटरप्राइज और टू रन अवर बिजनेस. इसी तरह ब्रेक इवन एनालिसिस में हम जो मेज़र करते हैं कि साउंडनेस कितनी है, हमारा हेल्दी चल रहा है हमारा बिजनेस एंटरप्राइज की नहीं चल रहा है, तो उसमें हम देखते हैं कितना कॉस्ट कवर हुआ है, गुड्स में कितना कवर हुआ है, जो हम सर्विसेज प्रोवाइड कर रहे हैं उसमें कितना कवर हुआ है. तो कॉस्ट कवरेज को हम देखकर उसकी एनालिसिस करके हम ये मेजर कर लेते हैं कि हमारा बिजनेस में साउंडनेस है कि नहीं है, वो ग्रो कर रहा है, हेल्दी है कि नहीं है. So these are the two major things, the break-even analysis and the cash flow statement to measure the soundness and the success of the business.
Very rightly explained by Asha that any business, any firms depends upon whether it is a sound or it's in a bad shape or it is not working well. It's all depend how the break-even point is there, how is the profit analysis is there, as explained by. Further, we would like to elaborate to our learners that how this can be measured, how the performance can be evaluated, because I think so unless until the entrepreneur or the owner of that firm understand to read the how the each units each component, whether it is working well or not. So how can it be measured? How what it's how it's play important role for the success, or how it contributes for the failures?
Okay, it's a very good question. And before explaining this question, I would like to one more point in the business success and failure. Business success and failure में we prepare actually annual profit and loss account statement. और ये जो है हमने जैसे अभी बिजनेस स्टार्ट किया, अपना कंपनी स्टार्ट किया या कोई इंटरप्राइज स्टार्ट की, उसके 1 साल होने के बाद 5-6 महीने हमको लग जाते हैं हम जब ये अकाउंट प्रिपेयर करते हैं प्रॉफिट एंड लॉस का. उसमें होता क्या है कि ये इतना लॉन्ग टाइम होता है कि अगर प्रॉफिट में है तब तो कोई इशू नहीं है. इफ़ द थिंग्स आर इन द लॉस और तो या डैमेज जो हो रहा है दैट विल बी द इररिपेरेबल डैमेज. तो वी शुड ट्राई टू प्रिपेयर अवर this profit and loss account statement in every month, so that we should know we are running our enterprise or running our business in a proper direction or not. वरना एक इतना ज़्यादा लॉस होता है कि हम उसकी जो भरपाई करना मुश्किल होता है.
By that time lot of water flows. तो वो irreparable है. If you feel if any particularly the new startup or new entity जो भी है, I think so it instead of going for the theoretical knowledge that wait for a year or wait for another 5-6 months to prepare a profit loss account and then take a corrective measures, and suppose it's a huge investment you have done it, so at that time उस फर्म एजेंसीज का काफ़ी लॉस हो जाएगा और and that will give a bad image to the firm.
और हमें उससे संभलने में बहुत मुश्किल हो जाएगी. एंड नाउ कम टू द परफॉर्मेंस इवेल्युएशन, कि किसी भी कंपनी का या हमने जो बिजनेस स्टार्ट किया है उसके परफॉर्मेंस को हम कैसे इवेल्युएट करें, उसकी सिग्निफिकेंस क्या है. तो टू क्वेश्चंस अराइजेज इन आवर माइंड. व्हाट इज द सिग्निफिकेंस ऑफ द परफॉर्मेंस evaluation of any enterprise, and what could be the methods to measure, to evaluate the performance. So we will focus on these two questions. Naturally है significance क्या है, कि हम कोई भी business करते हैं तो naturally है वो business हम profit के लिए करते हैं, और वो प्रॉफिट ईयर बाय ईयर जो है वो ग्रो करना चाहिए, तभी हम उसको और एक्सपेंड कर सकते हैं, उसका एक्सटेंशन हो सकती है. अब उसको, और जो हमने गोल अचीव किया है हर ईयर में कि हमको इतना प्रॉफिट इस ईयर के बाद हमको मिलना है, हमने ये बिजनेस किया इतना प्रॉफिट हमको मिलना है, तो उसके लिए प्रॉपर मेथड ज़रूरी है कि आप रेगुलरली एंड पीरियडिकली आप चीज़ों को मॉनिटर करिए और उसको इवेल्युएट करिए. अब मॉनिटरिंग एंड इवेल्युएशन के लिए आपको करना क्या होता है कि एक परफॉर्मेंस स्टैंडर्ड्स को सेट करना पड़ता है, इस्टेब्लिश करना पड़ता है. परफॉर्मेंस स्टैंडर्ड्स क्या होते हैं? वो दो टाइप्स के होते हैं. आपको जजमेंट standards and engineering standards. Judgment standards are those standards which are based on our experiences. हमने अपने जो पुराने एक्सपीरियंसेस हैं उसके अकॉर्डिंग वर्क स्टडी की, हमने ऑपरेशनल रिसर्च करके जान लिया कि हाँ क्या क्या चीज़ें हैं, क्या चीज़ें हमें इम्प्रूव करनी हैं. एक जजमेंटल
ऑन द बेसिस ऑफ पास्ट एक्सपीरियंस हम स्टैंडर्ड सेट करते हैं
और उससे कंपेयर कर लेते हैं कि हमारा बिजनेस राइट डायरेक्शन में जा रहा है कि नहीं जा रहा है. अगर जा रहा है तो वेल एंड गुड. If it is not running smoothly, then we should take the corrective measures immediately. And now come to the second type of the standards that are engineering standards. Engineering standards, it means आपका जो मॉडिफाइड टेक्नोलॉजीज़ हैं, साइंटिफिक मेथड्स हैं, थेरीज हैं, उन सब को उनका एक सेट तैयार कर लेते हैं और उनसे कंपेयर करते हैं चीज़ों को कि वेदर वी आर गोइंग इन अ राइट डायरेक्शन और नॉट, वेदर अवर कंपनी विल गेट द प्रॉफिट और नॉट. अगर लॉस हो रहा है तो नेचुरली वी विल take the corrective measures. So these are the major two types of performance standard under this. And now come to the evaluation, how we evaluate the performance. So there are again two types of methods or measures we can take to enhance our business or enterprise or company, whatever. अब एक जो आपको ये परफॉर्मेंस स्टैंडर्ड्स होते हैं दैट आर बेस्ड ऑन योर बजटिंग, बजट पे बेस करते हैं. अब वो बजट जो होते हैं, थ्री टाइप्स ऑफ फंक्शंस लाइक प्लानिंग बजट, मोटिवेशन बजट एंड कंट्रोल बजट. प्लानिंग बजट में क्या होता है, वो हम उसको वी प्रिपेयर ओनली वंस. प्लानिंग एंड मोटिवेशन बजट जो है हम केवल एक बार प्रिपेयर करते हैं. And the control budget we prepare twice, at the end, at the beginning of our business activity and at the end of our business activity. What is the planning budget? Planning budget could be operating budget or financial budget.
Projection also.
Yes, and yes, absolutely correct. The projected income statement we prepare under the planning budget. And motivation budget, that is like sales quotes for the company so that we can motivate the things and run our business smoothly in a proper direction to get the profit. And the control budget, that are assigned responsibility for the cost incurrence. It means actual cost को हम जानने की कोशिश करते हैं और उस हिसाब से अपना बजट तैयार करते हैं ताकि हम प्रॉपरली प्रॉफिट को गेन कर सकें और अपनी परफॉर्मेंस को बेटर कर सकें. अगर देयर इज सम इश्यूज देन वी इमीडिएटली वी टेक द करेक्टिव मेजर्स और करेक्टिव एक्शंस. और ये आपको पहला एक कैटेगरी हो गया जिसमें हम किस तरह से इवेल्युएट करेंगे.
This can also this budgeting can also work as a control measures to lead how what you are planning, what you want to see इंडस्ट्री को आप अपने 1 साल या 2 साल के अंदर हम कहाँ पे प्लेस करना चाहते हैं, तो अकॉर्डिंगली यू हैव टू टेक इनटू अकाउंट दोस थिंग्स। और बहुत एस्पिरेशनल्स, बहुत हाई ड्रीम, हाई गोल करके करें, देन ऑल्सो इट विल लीड्स टू ए फेल्योर। तो हमें लगता है कि जो एंटरप्रेन्योर्स हैं दे शुड नो दिस ऑल एस्पेक्ट्स एज डिस्कस्ड अबाउट द बजटिंग एंड फाइनेंशियल एस्पेक्ट्स यू शुड कीप इन माइंड। आपको नहीं है कंट्रोल तो इट इज़ बेटर, इट्स अ गुड टू स्पेंड लेस इंस्टेड ऑफ स्पेंडिंग मोर एंड यू डोंट हैव ए कंट्रोल एंड अल्टीमेटली आप लीड कर रहे हैं लॉस में। तो अल्टीमेटली क्या होता है, आपका फर्म, आपका बिजनेस, बैंकर्स के आगे आपका क्रेडिबिलिटी और वो सब काफ़ी डाउन हो जाता है। तो इन सब चीज़ों पे आप ज़रूर ध्यान दें बिफोर दिस थिंग्स। उससे पहले आशा आपसे ये जानना चाहेंगे, जैसे आप परफॉर्मेंस के बारे में बताया, उसके आपने एक मेजर्स भी बताया, कैसे परफॉर्मेंस को कैसे मेज़र किया जाता है, इंटरनली या एक्सटर्नल जो
एक सेकंड कैटेगरी है मेजरमेंट की, परफॉर्मेंस को इवेल्युएट करने की। उसमें हम 3 टाइप से स्टैंडर्ड्स फॉर्म करते हैं। हिस्टोरिकल स्टैंडर्ड्स, एंड द सेकंड वन इज़ द बजट स्टैंडर्ड्स, एंड द थर्ड वन इज़ द हॉरिजॉन्टल स्टैंडर्ड्स। हिस्टोरिकल स्टैंडर्ड्स मीन्स योर पास्ट परफॉर्मेंस ऑफ द कंपनी। हमारी कंपनी पिछले साल प्रॉफिट में थी, तो हमने क्या क्या चीज़ें मेजर किए थे, कैसे उसको ऑपरेट किया था, हमारे क्या एक्सपीरियंसेस थे, उनको ध्यान में रखते हुए, उन स्टैंडर्ड्स को ध्यान में रखते हुए हम इस साल का जो काम कर रहे हैं उससे कंपेयर करके इवैल्यूएशन करते हैं अपनी परफॉर्मेंस को। दूसरा टाइप का होता है आपको बजट स्टैंडर्ड्स, कि हमने जो है आफ्टर प्रिपेयरिंग द बजट एज अ सेट पीरियड, इस पीरियड में हमने कितना बजट, कहाँ खर्चा किया, कैसे किया, कहाँ लगाया, ये सारी चीज़ों को हम ध्यान में रखते हैं, एक स्टैंडर्ड सेट कर लेते हैं और अभी हम क्या कर रहे हैं उससे हम कंपेयर कर लेते हैं। तो उससे हमारी परफॉर्मेंस इवेल्युएट हो जाती है कि वेदर वी आर गोइंग आवर बिजनेस और वेदर वी आर रनिंग आवर बिजनेस इन अ प्रॉपर डायरेक्शन टू गेट और ऑब्टेन द प्रॉफिट और नॉट। अगर कहीं लॉस है तो वहीं हम करेक्टिव मेजर्स ले लेते हैं। एंड द लास्ट वन कैटेगरी इज हॉरिजॉन्टल स्टैंडर्ड्स। हॉरिजॉन्टल स्टैंडर्ड्स जो होते हैं वो आपका हॉरिजॉन्टली मीन्स दूसरी, ये इंटरनल कंपनी से रिलेटेड नहीं होते हैं, एक्सटर्नल कंपनी से रिलेटेड होते हैं। अगर वही बिजनेस दूसरी कोई कंपनी कर रही है जो आप कर रहे हैं, उससे हम हॉरिजॉन्टली कंपेयर करते हैं कि उनका अगर प्रॉफिट हो रहा है तो क्यों हो रहा है, कैसे हो रहा है। तो वो एक स्टैंडर्ड्स उनके सेट हैं, उसके अकॉर्डिंग हम अपनी कंपनी के स्टैंडर्ड्स को सेट करके अपने बिजनेस को ग्रो करते हैं।
कर सकते हैं। राइट, आपने बताया एक तो द सिस्टम इज दैट कि टू मेजर योर परफॉर्मेंस इज टू डू जस्ट वी हैव जस्ट लाइक in the teaching learning process we have a continuous evaluation. So internal evaluation, internal performance appraisal also one should do, but also side by side at that some point of time you have to measure yourself in that ecosystem, in the same trading community. Suppose आप गारमेंट इंडस्ट्रीज में हैं या सर्विस सेक्टर्स में हैं, टूरिज्म में हैं, जस्ट सी योर कंपिटिटर्स, व्हाट इज देयर ग्रोथ, एक सर्टेन ईयर्स पे है, क्या मेजर्स उसने लिया। सो आपको अपने सेम उस पे उस उस स्तर पे दूसरे ट्रेड्स कितना अच्छे से परफॉर्म कर रहे हैं,
इंडस्ट्रीज क्या कर रही हैं,
कैसे कर रही हैं,
कैसे प्रॉफिट गेन कर रही हैं, तो वो एक स्टैंडर्ड सेट कर लेना चाहिए और उसके कंपेयर करके अपनी कंपनी का अडॉप्ट करना चाहिए।
वेरी राइटली we have discussed and covered. Now coming आगे हम लोग इस पे डिस्कशन करना चाहेंगे कि some important aspects है that theory of conservatism. Important is that of course one should plan, because the entrepreneurs come with the very good idea, big ideas. लेकिन as we are discussing right now, you should have a very financial sound knowledge about finance का आपका क्या positions है, from where you are getting sources fund. So this theory reflects to you have to think maximum bare minimum हमारा कितना loss हो सकता है, क्या हो सकता है expenditures हमारा कितना maximum loss, you have to plan in that way कि in case हर चीज इफ इट्स नॉट वर्क वेल, इट्स गोइंग वर्स्ट इन कंडीशंस में, तो आपका लॉस का क्या होगा? तो इफ यू प्लान इट फॉर दैट, इन द वर्स्ट कंडीशंस में हमारा इतना लॉस हो सकता है, एंड इफ यू कैन प्लान इट, फंड का, सोर्सेस का, फाइनेंस का, रिसोर्सेस का, इनपुट्स का, तो इफ यू कैन प्लान इट अकॉर्डिंगली, देन there is very less chances for your getting your business down or low, failures का बहुत कम chances है. So these things you should plan in well in advance. The other important is the asset management. For any firm, any institutions, any business,
Yes.
assets play very important role. Asset means we mean to talk about the buildings, where this business will start, where the service, where your office staff will sit, how it will be. So idea is to have the key point is that any startup or any new enterprise, it is better, it is advisable to go for on the rental building. अब प्रारंभ में अवश्य ही किराए पे बिल्डिंग्स लें इंस्टेड ऑफ गोइंग फॉर देयर ओन बिल्डिंग. ऑफ कोर्स द रेंट कंपोनेंट विल बी देयर. एक जनरली 30 to 35% ऑफ योर capital or whatever is there, it goes on the assets. Means your building, your land, whatever the things are there. So of course you are spending 30%. But if you suppose in the beginning में ही हमने कुछ बहुत अच्छा प्लान किया and you have thought no in excitement we should have this things in our own building, हमारा asset भी हो जाएगा. But what you are doing, you are blocking your money in where it may not get a returns. In the beginning, for any firm agencies, you need a मनी, फाइनेंस, जिसको हम कहते हैं कि एक अपॉर्चुनिटी कॉस्ट होता है. आपके रिसोर्सेज वहीं पे आपका ब्लॉक हो गया, एंड सम टाइम सम अपॉर्चुनिटी गॉट इट इन द मार्केट, देयर इज, यू कैन ग्रैब इट, यू नीड टू पुट फॉर द सप्लायर्स, वहाँ जहाँ पैसा हम डाल सकते थे, लेकिन हमारा पैसा ब्लॉक हो गया, हम अपनी बिल्डिंग, हम अपने लैंड खरीदने में हमने लगा दिया. दैट्स व्हाई इट इज सेड इट इज बेटर टू हैव start your business with on the rented house. Maybe down the line, on the basis of the success, adopting the measures what we were discussing, the control measures, the finance, the budgeting. Once your firms, suppose your business is running very smoothly for 5, 10 years, 15 years, then you can go for plan for your own building, own houses. Definitely your profit will grow because you need not to pay the rent. So this is, we are talking about the growth asset management. The other important is the growth strategy. Growth strategy means any industry, any firm should have a growth story. Unless until it is growing, it is alive, it's kicking, then it won't be considered as a growing industry. So you have to maintain the business, as we were saying, the finance, the controls, the management aspects, managing the liability and maintaining the accounts. This is also very important until you have a control on liabilities. Because it will lead to, if you have more liabilities than the assets or your capitals or fund, it will leads to your loss. So you have to check on those liabilities, and also the balance between liability, cash and assets. So you have to maintain it in a very scientific way, very logical way. Then you can maintain the things and run your business in a very profit way. Then maintaining the account is also very important, as we were telling. So if you know it well, then only spend money on different things. Don't go for the risk or something. Also there is a terms called debt trading. So you have to maintain this thing, equity and between debt. It is generally, it is ideal is the 3:1. One has to maintain it. 2:1 is the better. Then you have a scope for going for the more borrowings. If you reach to the 3:1 already, and some opportunities are there where you need some money, where you can borrow from the bankers or the funders, you don't have a opportunity to take, because bankers who give the grants, who give the loan, they see how is your performance, particularly with the debt equity ratios. So you have to maintain right in the beginning. पर्टिकुलरली जो ऐसे फर्म्स, जो ऐसे इंस्टीट्यूशंस हैं जो नए हैं, उनको अपना ये रेशियोज 2:1 को मेंटेन रखना चाहिए, जैसे ही एक ऐसा सिचुएशंस आता है, एक मार्केट आता है, तो वन कैन. नाउ कमिंग टू द फिफ्थ यूनिट्स which we talk about the what is the productions, how is the product should be there. So for that, one should be very important is the suppose if you are going for the any manufacturing unit or so important, very important, and as a lay observation is there, your plant should be very close to the raw materials, so that you can reduce the cost on transportations, on bringing the raw material. If it is a very far दूर है, तो वहाँ से आपको ट्रांसपोर्टेशंस के कॉस्ट पड़ेंगे. दूसरा, मार्केट्स, इफ़ यू हैव ए वेरी क्लोज टू योर लोकेशंस, then it play also very important. These are the factors which play very important role in your profit making firms. Then the adequate power and water arrangements, transportation facilities and their costs, labor and wages. It play a very important role. If you divide the costs on the assets and labors, and so labor and wages play. And if your nature of the industry or your nature of the things is more labor intensive, then definitely you should keep in mind that less costs are put over there on the labor and wages. Laws and taxations also you have to keep in mind, because some states are very friendly in the law form, because they encourage the new industry, new startup. So you can choose such type of states in the beginning to establish your plant locations over there, so that in the beginning you get a push over there, so that you can make the profit, and gradually you can move for the these things. Similarly, you have to take clearance from the climate and the environmental issues. These are the legal requirements before setting of any industry for any firm. So hope in today's sessions we both of us has tried to touched upon this important topics, important terms which we feel as a course coordinator, program coordinator, that you need clarifications further. But in any case, as we keep on telling you, that any point of time, any time you feel it, further elaboration, further discussions, please write to us. Our mail is with you. So we wish, हमें उम्मीद है हमारे जितने भी शिक्षार्थी, हमारे विद्यार्थी हैं MER प्रोग्राम के, तो इस सेशन से लाभान्वित हुए होंगे, और उम्मीद करते हैं फ्यूचर में, भविष्य में आपको इस तरह की किसी तरह की आवश्यकता हो, इस यूनिट से रिलेटेड, इस प्रोग्राम से रिलेटेड किसी तरह का क्वेरीज हो, कृपया कर हमें लिखें. हमें बहुत खुशी होगी उसको जवाब देते हुए. थैंक यू.
थैंक यू.
आसाम की विशालता केवल ब्रह्मपुत्र नदी तक सीमित नहीं है, बल्कि यहाँ के सांस्कृतिक वातावरण में भी दिखाई देती है.
यही वह कामरूप है जिसकी गाथा पौराणिक कहानियों में भी पाई जाती है.
मैं कामरूप हूँ. मैं साक्षी हूँ उस पौराणिक काल का. प्रभु महादेव की करुणा से मुझ में ही कामदेव को नया जीवन मिला, इसलिए मैं कामरूप हूँ.
ऐसी ही एक पौराणिक गाथा जुड़ी है आसाम के गुवाहाटी में स्थित मां कामाख्या देवी के मंदिर के साथ.
प्रतिदिन यहाँ हजारों की संख्या में श्रद्धालु भक्त मां कामाख्या के दर्शनों को प्राप्त करने के लिए समस्त संसार भर से यहाँ पर आते हैं.
जिस पहाड़ी पर मां कामाख्या का मंदिर स्थित है उसे नीलांचल पहाड़ कहते हैं. वर्तमान में मंदिर तक पहुंचने के लिए अति उत्तम मार्ग की व्यवस्था है.
परंतु एक समय ऐसा भी था जब लोगों को पत्थरों की सीढ़ियों पर चढ़कर वहां तक पहुंचना पड़ता था.
भक्ति के साथ साथ यह एक पर्यटन स्थल भी है. यहाँ के स्थानीय निवासी इसी पर्यटन से अपनी आजीविका भी चलाते हैं। हर वर्ष आषाढ़ माह में मंदिर के द्वार कुछ समय बंद रखने की परंपरा है, जिसे अम्बुवासी कहते हैं। अम्बुवासी के दौरान देश भर से लाखों भक्तजन यहाँ पर आकर रात बिताते हैं।
मंदिर खुलते ही भक्तजन मां कामाख्या के दर्शन कर लेते हैं। अम्बुवासी प्रवृत्ति के समय यहाँ अत्यंत भव्य मेला लगता है। भक्तों की ऐसी ही भीड़ नवरात्रि में भी दिखाई देती है।
Welcome to Gyan Darshan. I'm sure there are a lot of our students who are watching this. Even if there are no students, it's also for a general audience who may be interested to know more about Indian society. This particular topic that I'm going to be talking about today is Indian civilization, which forms the very beginning of our course, BSOG 171, which is on Indian society. Colon Myth and Realities. So basically this course deals with getting our learners acquainted with Indian society in general, not only from a historical perspective, but also in the contemporary context. But more importantly, we have certain notions about what India is. And this course tries to in some ways capture these notions that are there about India, and as well as talk about realities which in some way go against what we normally hold as our favorite view. So in the very beginning of this course, we have a unit or a lesson called Indian civilization. So the topic today is Indian civilization. As you all know, and I think all of you are familiar with the fact that Indian civilization is one of the oldest. There are many civilizations in the world. You must have heard of the Indus Valley civilization, and then of course the Harappan civilization, which is in some ways part of the Indian civilization. So, as such, when we talk about Indian civilization, we're talking about a long history that India has had. And this history dates back to 3,000 years ago. And I'm just giving you a rough periodization of that history. And so it's this long history which has in its course of its in the course of its time has not only been a series of eventful happenings that are part of history, but it's also a mix of many migrations, cultures, and so on and so forth. So India is basically a very diverse country. I think it's important that we first look at this diversity of India, which I suppose you can see it in terms of the geographical, physical, environmental, racial, ethnic, religious, and regional. One of the things I must point out here is that oftentimes you hear the word India is a subcontinent. You know, it is a subcontinent for the simple reason that we have all kinds of geographical features in India. We have the desert, we have the mountains, really high mountains. In fact, the Himalayas are one of the highest mountains in the world. And we also have a vast expanse of the sea coast and the sea. So we have a multivarious physical features, and along with these physical features, obviously there are many climatic conditions. For instance, in the desert regions of northwest India, which is part of Rajasthan, Gujarat and all, we have very few things that grow. So the food, the culture, certain aspects of daily life revolve around this kind of a geographical and environmental context or the setting in which they are. Similarly, we have coastal regions which are predominantly seafaring, fish-eating people, and then you have, of course, the deltaic regions, so on and so forth. So there's a lot of geographical variations within India, which makes for a diversity in itself, not only in terms of geography, but also the people's habits and way of life. So that is one big diverse aspect that is that's so unique to India, and of course many countries, but it is one aspect of India. The other is, as I mentioned, if we go back to the previous slide, it's the other one, as I mentioned, is the racial and ethnic diversity. India is home to many varieties of people, and these varieties have come about in Indian context through a series of migrations. Over a long history. I'm not only talking about civilizational history, which is about 3,000 years or so, but even longer. So we have a variety of racial mixes in India. We have the Mongoloid and even some Negroid and Caucasian. And then, of course, it also means that we have a lot of ethnic varieties. Now, when we talk about ethnicity, we typically think of a community which has a very strong sense of that is, they feel that they're a part of a community. And the basis can be either language, religion, or a region, and so on and so forth. So we do have a lot of ethnicities. The fact that we talk about Bengalis or Biharis or on the basis of language, you have Gujaratis, Marathis, and so on and so forth. So these are all ethnic communities in their own right. We also have tribes, many tribes, which also can be considered an ethnic group. So ethnicity can be on the basis of language, religion, a region as well. And yes, I think mostly in those terms, I think at this moment we will just keep to that. As I mentioned already in our slide, that religion also is one of the aspects which gives a diversity to Indian culture. And if you know, India is home to many religions. you'd be surprised to know that Christianity came to India as early as 1st century AD, which is really early. So we have a long history of people, taking to other religions and converting. And of course, Hinduism is one of the oldest religions. We've also have given birth to many religions, such as Jainism, Buddhism, which of course has spread across the world. So religious diversity is another aspect of Indian subcontinental and civilizational feature. As I already mentioned, regional diversities, there are many, The fact that we have, we often in our everyday language refer to South and North. We also say East, people from the east of India. When we say Northeast, we are thinking of a distinct regionality. Or when we say North India, we think of a distinct regionality which is united by either, their way of life or language or a conglomerate of languages and so on and so forth. So regional diversity is another aspect of Indian civilization. Now, given this long history, this kind of diversity in geographical features, the ethnic diversity, the religious diversity, all these regional differences, obviously India then becomes a very complex country for most people to capture. So Bernard Cohen, who's a historian and also an anthropologist, he has identified certain approaches to the study of India. And in today's lecture, I would like to very briefly give you an idea of what these 3 or 4 approaches are. These approaches are the catalog approach, the cultural essence approach, the cultural communication approach, approaching India as a type. But before we go on to these approaches, what I would like to bring to your attention is the notion of civilization. So what is civilization? Can all societies be considered civilized? Well, civilization as a word also has a lot of value notion added to it. We often think of civilization as more desirable than savagery, which is, quote unquote savagery, which is non-civilized people. But if you were to look at it completely from a neutral angle, civilization is a description of a certain kind of society. It helps us to kind of make a typology of a particular society, and some of the traits which have been identified or features that are identified as part of a civilizational society are that there are agricultural practices, practiced agricultural practices, as well as trade. There is planned dwelling, so when we say, for instance, Indus Valley civilization, you must know that Indus Valley civilization had some sort of a planning, the roads were at right angles. They had some kind of drainage system. There was some kind of a public facilities, so on and so forth. So that's what we mean by planned dwelling. In addition, we have multiple cultures, so which in some ways shows that there is a lot of diversity in that culture. They could be class divisions, they could be caste divisions, or they could be divisions in terms of professions, guilds or artisans and so on and so forth. So basically, in some sense, this division of labor. There's also art, there is religion, there is administrative units, and some sort of a political structure. They needn't be kings, but there could be at least some kind of a town planning, or that would be the administration, but some kind of a mayor of a town or a city or some such thing. So some kind of a political administrative setup. So these are aspects which we often associate with civilization. So having said that, let's see and try and understand what these approaches are which Bernard Cohen is talking about. So, as I mentioned already, these approaches are the catalog approach, the cultural essence approach, the cultural communication approach, and approaching India as a type. So, these are the ways in which we can look at India. Let's look at each one of these approaches. The catalog approach, basically what it is trying to do is, when we say cataloging, we collect a particular amount of data or features and then catalog them. So basically cataloging institutions, maybe certain traits, so on and so forth. In some sense, if you remember, you have probably already familiar with the work of Dumont, and he talks about hierarchy as one of the traits of Indian civilization. It can also be seen in terms of, again, in Louis Dumont terms, as purity and pollution. So those are elements of these institutions, which is a caste system, and then within that there are these additional traits, which, if you can call them traits. So that could be one way Indian civilization has been approached, which is to capture the kind of institutions, traits that are predominantly found in the Indian subcontinental context. But again, some of these are notions. The idea of purity pollution, of course, exists to a great extent, but there are also notions. Notions of hierarchy, when you actually do field work, these notions sometimes are very blurred. So in one sense, this particular approach depends heavily on notions. Subsequent approach that we look at has certain overlaps, which is the cultural essence approach. This approach also, in a way, is looking at certain essence that is Indian society or Indian civilization. One such essence is the fact that it's a very diverse land, and yet there seems to be some kind of a unity. So that's one notion that captures in some ways, and we often hear of this phrase, unity in diversity, which I suppose can qualify as the spirit or the essence of Indian society. But then again, it's a matter of opinion. So it is just an approach or a way of looking at Indian society. In addition, our third approach, when we look at cultural communication approach, it's a very interesting approach. Sociologists have relied on this kind of approach to understand Indian civilization. Basically, this approach looks at the content and processes that are disseminated or even communicated across different regions of India. Two very important sociologists come to our mind when we talk about this approach, and that's Mackim Marriott and Robert Redfield. Now, both these sociologists in the 50s and later in the 60s have done a lot of field work. Robert Redfield has done it in Mexico, and he's also done his field work in India. So they try to understand India as a civilization, as a society, and they come up with some very interesting and important concepts. We look at those concepts, one of which is great and little tradition. Now, Robert Redfield and his students studied a number of folk and urban communities in Mexico and India. And then they came up with these sort of concepts to understand how the urban and the rural, or the folk and the city, and how do they interact. And they've come up with these sort of a binaries, two opposing kind of conceptual categories. And the binaries that they have come up with is the great tradition and the little tradition. They basically are dimensions of a civilization. So, for instance, when we say urban and rural, modern and traditional, they're also binaries. So, in a similar way, Redfield comes up with this idea of the great and little traditions. So, what are great and little traditions? According to Robert Redfield, the worldview of the little traditions of India on the whole is polytheistic. Polytheistic, magical, and unphilosophical. They are more located in the local. So in some ways they bring out the local flavor, and they also come from a tradition of not textual references. So they are not written texts, but of course not written text, but they don't also follow any kind of textual references. But there is an allusion to the text, no doubt, but there is some sort of an interpretation of that textual origins. Just to give you an example, we have the Valmiki's Ramayana, which is considered one of our epics and almost a sacred text in many senses. But when you actually see how this Ramayana is expressed or even thought of or performed, then you'll find that there are so many variations within India. So I think one best example, in the recent times we've seen within India, you'll have different kinds of Ram Leelas, and they all have these regional flavors or folk elements. But interestingly, some of them also have their own interpretations. A very good example of this is Pandavani, which is a folk tradition in Chhattisgarh, which became very famous with our very famous performer artist Jijanbai. If you're interested, go on YouTube and type in Pandavani, and you will see what this performance is all about. It's fascinating. So it takes on its own regional flavor, and particularly a performance within the Pandavani tradition, which is called I forget the name. It's called the Kapalik, where the artist has been very imaginative with interpreting some of the characters. It's very gestural, very dramatic. So you could say it's got a little more layers. So as you can see, the little traditions are folk traditions, which, as I mentioned already, are magical, more narrative oriented, not necessarily textual, not philosophical either, so on and so forth. As against that, we have the great traditions. Now, the great traditions tend to be more textual, philosophical, more alluding to the larger concerns of life, such as morality, life in general, more philosophical, so on and so forth. They can be abstract, like, the Upanishads. Upanishads are Vedic texts, but they're highly philosophical and may not be easily accessible to the ordinary folk who live and farm or go about their daily life. So this is the distinction he made. And we'll come to the second concept before we go into a little more detail about these two concepts. And the second concept or twin concepts that Malcolm Marriott has come up with is called the universalization and parochialization. Malcolm Marriott, like Robert Redfield, has done extensive field work in India, and he explains some of these concepts with great detail from the field. So when he proposes these concepts, he's basically trying to understand how in India various aspects come together and or the processes go back and forth from big traditions to small traditions, or the great tradition to little, and from the local to the global, or what he calls as universalization. So many folk traditions become part of the universalization aspect. So it's possible that some deity, perhaps which was so local, becomes more prominent over a period of time, and then very soon they become the deities or rituals around that deity become part of the civilization or part of the Indian culture at large, combining many regions, many ethnicities and castes. Offhand, I can't think of many examples, but there are many contemporary examples which may not fit in exactly with the way in which Mackie Marriott has described. But one such example would be the fact that in India, the wedding tradition is becoming more and more universalized. So much so, certain elements are found in different parts of India. For instance, the repertoire of dance, which used to be not there in East or maybe South India. So these are some of the concepts, and very quickly I want to mention the fourth approach, which is to look at India not in terms of qualities but as a type. So when we say a type, you can say India is either a agrarian society, even as a device, like an ideal type, let's say, and then use it for comparative purposes, right? But you'll have to find a similar such comparative landscape or a society so that we can compare. So we obviously can't compare caste system because it's so unique to India. With this quick summation of these four approaches, we conclude our today's lecture, but we'll continue with this discussion in our subsequent lectures. So tune into our Gyan Darshan and follow our lectures, so it will really help you all to understand some of our course material. Thank you very much.